Welcome to a new episode of the Startup Show. Today we are here at the headquarters of Redalpine, one of the biggest venture capital funds in Switzerland, and I have the big pleasure to introduce you to Michael, one of the founding partners. So welcome to the Startup Show.
Hey, hello, Cedric.
Welcome to a new episode of the Startup Show. I'm very excited to be here at the headquarters of Redalpine, one of the biggest venture capital funds in Switzerland. It's really great to meet with you here in front of the camera. So as usual on the Startup Show, you're gonna have to briefly introduce yourself to the audience, so it would be great to get a little bit of an introduction.
Pleasure to do so. Hello, Cedric. Welcome at Redalpine. So I have a background in the life science space, so I did a PhD in that space because I just liked it. My idea was always do what you like and then you become good at it. And I did a PhD in the field of molecular biology in the plants area, and then I realized that I have very broad interests, and had the opportunity to join the Boston Consulting Group thereafter. I spent 5 years with BCG and I really learned a lot. It was fantastic for me because I did not have any clue about economy as a PhD. That was in the late 90s. I was infected by the entrepreneurial bug. That was when the dot-com bubble was, that was when First Tuesday started to happen, that was when the first entrepreneurs in Switzerland, the first startups happened. So I was really infected by that, and after 5 years BCG I joined a biotech startup company, Prionics, and I was responsible for their basically a product platform and then for their M&A and corporate finance. Because they made a lot of money with one product, and I had the opportunity to acquire multiple companies and portfolios of companies to set them on a sustainable basis. During that time I started to do first angel investments. That was sort of around 2003 and 4, and I started to realize there is really great potential in Switzerland and by the way also in Europe of innovation which gets created and which is not properly commercialized. So with a couple of American friends but also Swiss angels, we started to develop ideas. How could we support that? And quickly realized actually what's required is a seed stage venture capital fund. And that was the birth of Redalpine. We started in 2007 with our first fund, raised the fund, invested that over the next 4 to 5 years. That was quite challenging because we started right away into the bubble. The banking crisis, the financial crisis in 2008. That was not that easy because you never knew where is the market going, is the world going to look like in 2009 the way it did before. Nevertheless, we sort of went through that difficult period with our investment strategy and it paid off later on.
Right.
We raised Redalpine Capital 2 in 2012, invested again in our areas. And with the performance of Redalpine Capital 1 and Redalpine Capital 2, we were able now to raise Redalpine Capital 3, which is developing. We are at the beginning of that and it's developing really nicely.
So maybe, before we go more into like your investment strategy, maybe we can talk a little bit. A lot of my audience are investors and startups, but I also have a lot of students because of my network.
Right.
So maybe you can give 1 minute like a tip how to become like the next venture capitalist, or like what's an interesting or promising way to pursue a career in VC.
My main advice is if you want to become an early stage VC, before you do that, become an entrepreneur. This is really the best school you can do. It's not like do an MBA or go into a corporate position. I would say start a company yourself, learn it from the scratch, learn how it feels to be an entrepreneur, because as a VC, you really, at least in the early stage, you really have to think like an entrepreneur. So that's really the best way to get into it.
Right. So let's go a little bit into the portfolio companies. You invested like in N26, one of the biggest digital, if not the biggest digital bank. You had Yodel, some very interesting investments. Maybe you can give us a little bit of an understanding how you decide on which is your next investment.
Right. So generally we have our sectors. We have the tech sector. We call it tech. It's mostly software-based business models, mostly mobile-based or internet-based. just the typical tech stuff. And then on the other side, we have life tech or health tech, whatever you want to call it. It's more disruptive changes in the field of life science with platform technologies, with personalized medicine, diagnostics, but also digital health, the convergence of the two sectors. So that's our broad pool that we look at. And then the geography is mainly, we do lead investments in Germany and in Switzerland. And we do co-investments in other European countries. So basically, that's the way we screen our deal flow first. It has to be within our scope. Then typically we invest in right around the Series A, slightly before Series A, sometimes with Redalpine Capital 3. What we really want to see, and the most important criteria by far, is the quality of the founding team. The quality of the founders is really what drives the success and drives the company. And if the founding team is great, they will manage also crises in the future. They will be able to get through difficulties. So therefore, really the quality of the founding team is, I would say, 60 to 70% of the future success of that company. Now, wow. The big question is that you may ask, if this is so important, how do you assess the quality of the founding?
So you ask yourself, how do you assess the quality of the founding team?
It's of course not that you can go into a data room and look at a couple of CVs and you then can say, okay, wow, they tick all the boxes and it's a great founding team. That's not the case. The only way you really can figure out if it's a great founding team or not is to follow the team. I mean, see them somewhere at the first very early point in time, learn what they want to do, follow them, see them again, maybe a couple of months later, see how they have developed, see if they have managed a couple of challenges, how do they behave within the team, with potential investors, with potential customers. Just figure out in the end, are they just nerds or do they have the potential to be entrepreneurs? And also that's one thing. And the second really important thing is it's got to be a team. And by team, we mean at least two people on the same level. It's not like one strong entrepreneur with a couple of employees. That can work, but the chance to be successful is much better if you have a team of like-minded people that are taking decisions together. It can be 2 or 3 people. That's really the best. And my best advice to people in a very early stage how to maximize their chances for success is go out and find a good co-founder. That's really the best thing you can do at the very beginning.
Right, absolutely. So what's interesting, like when we're discussing, and you're not the only investor, that I hear that it's you don't at all talk about finance, multiples, all kinds of like valuation models. And I'm always curious to know, like when you value or when you give a certain valuation to a company, how do you get to this valuation? So maybe you can like elaborate a little bit, like when you say like, okay, we do Series A, how do you get to the valuations of these startups? Because a team is like, it's a score. You can say like it's a great score, but you can't really give that a certain valuation.
No, that's not possible, of course. To have a fact-based valuation is very, very difficult. I mean, there are a couple of competing companies that may be ahead or behind, but where you have sort of a first indication about the valuation because you know the valuation of these companies, you know how they have developed, so you can do a comparison there. Then quite generally, we see every year about 1,500 proposals. So we daily screen companies and we daily learn about their valuations and their valuation ranges. We definitely just have a feeling what we believe could be a good value for an investment in a company. The valuation certainly is important. I would still say the valuation is not the most important thing. We are ready to compromise if it's within a certain range. In the end, the overall package has to work. It's got to be the package, the people. Again, it's got to be all the terms. Like what other terms do you have in this investment? Do you have milestones? Do you have liquidation preferences? Do you have whatever anti-dilution, employee stock option plan? All of that is in the end, it's got to be a good package. And I believe also that's our philosophy. It's not like a deal on eBay where you maximize the transaction. It's much more like getting married. Really. I mean, in the end, you have to be within the same community or household in a productive way together. And that's much more important. And so if you end up with a situation at the beginning when you invest as an investor, when one of the parties is not satisfied with the deal, that's a very bad start.
Yeah, right.
So
that's
therefore, the valuation is important, but in the end, both sides really have to buy in that this is the best valuation, or that's the appropriate valuation. Valuation can be determined by comparisons, it can be determined by discounted cash flow, but usually that's more to validate the gut feeling and not really to come to a conclusion, because in the end with the DCF you can end up wherever you want. I mean, yes. that's exactly the case.
For sure. So let's get a little bit into your expertise, what you see in terms of the venture capital trends. How do you see where we're heading with like startup investments in the next couple of years? We see like there was definitely a big boom, like let's say when you look over to Tel Aviv and Israel, a lot of investments going on there. What do you see here in our region, Europe, Switzerland?
Yeah, you're absolutely right. Tel Aviv is doing incredibly well. They're doing definitely a couple of things right, as well as, of course, in the US, in the Silicon Valley and wherever. I see a huge potential in Europe. You know, it's like the startup ecosystem in Europe is getting of age. Mm-hmm. You see Berlin, you see London, you see also in Switzerland, a lot is happening. So you have serial entrepreneurs now, you have all the structures that you need, the ecosystem, and very importantly also for students, it has become an absolutely equivalent career alternative to join a startup or to start a startup. That was not the case, let's say 5 to 10 years ago. And so therefore you end up having really good quality of people doing that. So all the different ingredients now converge in a fantastic situation. We see it in Berlin quite much, that the whole thing is getting onto a new level. You have serial entrepreneurs, they start new companies, they just call their former team members, they exactly know whom they need on what position. You know, I need this guy as a CTO, I need this guy as a CMO. It's one phone call, they all get together to form a new company. They also have the investors at hand, you know, they get the investors in. They are incredibly fast. We see more and more also overseas investors coming in Europe, especially American investors, but also Asian investors. Yeah. So it's converging to really be a fantastic situation. And what's for us as an investor even better is that there is still this lack of capital in the Series A. So in the end, it's an ecosystem which is developing really well, and where we still, for maybe the next couple of years, have a buyer's market as the investor. From on Series B or C, there is more capital available, and at the very beginning in the seed stage, there is also enough capital available, but in between, there is a gap. And as an investor in that gap, you have quite a great opportunity right now in Europe.
So demand supply, like all of the
demand and supply. Right. So I see, to summarize, I see no reason why we will not be able to generate the same great returns in Europe as the Americans have been doing for the last 10 to 20 years or even 30 years. This is happening now, and I see a great potential to catch up in Europe. We have also just seen recently amazingly 5 out of the 10 most highly rated computing institutions in the world are European universities. Mm-hmm. And amazingly, number 1 is ETH in Zurich. Wow. Actually. It's ahead of Stanford and the others. So this is really cool. I mean, this just illustrates what's happening and what we can expect for the future.
Right. So one last question before we wrap up the show is, you know, like you are with, you said before, marriage between the venture capital and the startup. At some point, you exited a few of your companies already. How is that process going? You know, we talk a lot about like the early stage, the investment, but then there's also at some point where you have to cash out, sell out, or get this money. How is it, let's say, for a company, for a startup, and for the venture capital to sell one of these companies?
So like getting divorced?
Yeah, well, but it's a good divorce, I guess. It's mostly that goal.
The only reason why we invest is because in the end we want to make a return.
Yes.
And that return is getting generated for the venture capitalists by doing an exit. So either doing a secondary transaction of the shares, or doing a trade sale of the company, or going public with the company. So it has to happen eventually. Now, this has to be clear to the founders from on the beginning. If this is not mutually aimed for, then you better don't even get engaged.
Right.
So it has to be clear for the founders that the investors at Redalpine wants eventually to cash out. Then there is an opportunity there. You have to take the assessment, is this now the great opportunity or is the great exit opportunity coming in the future? Sometimes a discussion you have to have, is this now in German we say, Spatz in der Hand oder die Taube auf dem Dach? And so usually you have to take that decision. As an investor, there are really opportunities to exit, and sometimes it's good to do an exit and not to be too greedy,
right?
Because sometimes there is an opportunity there, and it's not coming back soon. and when there is an opportunity and you seem to have a good price for that, then I guess it's time to let go. And mostly then, the ways part again. The founders, in a trade sale, they need to stay with the company because they have an earnout or they have an arrangement with the acquirer that they need to stay. And we, of course, get out of the board and out of the company and sell our shares. And so you part ways. Hopefully, of course, you meet again in the future. And I think this is really one of our biggest assets we have by far. This is the network, the entrepreneurs of the former companies that we have invested already in the beginning of the 2000s. This network is providing us with the greatest deal flow you can imagine.
Absolutely.
And to have these relationships to these experienced entrepreneurs who potentially will become angels and potentially maybe even VCs, this is really fantastic. And so getting married, parting ways again, but staying together in the same network is fantastic.
For sure. That's a great wrap up. Relationships matter, also in venture capital investing, which is really interesting. Thank you very much for your time and your insights. Guys, thank you very much for watching this episode of the Startup Show. It was a big pleasure to be here at the headquarters of Redalpine. See you very soon with another episode. Have a great day.